Hello, this is Brad Harvey with Harvey Investment Management, and today we're going to do an overview of the second quarter's performance and year-to-date performance in the overall financial markets. As all of you, I'm sure, know, this has been a pretty challenging environment across the board. We've seen a lot of things that we haven't seen in a long time. In fact, there was a headline earlier today that said that this is the worst start in the NASDAQ in over 50 years to a year. That's a really interesting quote. I did not go back and double check the math, but it certainly makes sense. In this video, we're going to talk a lot about numbers, and I apologize up front for how many numbers we're going to cover, but it's just where we are. I'm going to be focusing on year-to-date numbers so that we have some idea of what this really has meant. First of all, the first quarter GDP, our overall economic growth, printed a negative number for the first time in a while. It was minus 1.6%. We don't have the numbers for the second quarter yet. We also don't have the numbers for the second quarter in terms of inflation, but the inflation rate has been growing at an annualized rate of about 8.6%. So let's talk in terms of the markets. The Dow Jones Industrial Average, which is held up on a relative basis pretty well, was actually down 15.3% year-to-date. Again, these are year-to-date numbers. The Standard & Poor's 500 down 20.5. The NASDAQ Composite down 29.5. Again, this is year-to-date. The Russell 2000, which is the small cap index, was down 26%. And the NASDAQ 100, which is a tech index, was down just under 21%. It was 20.9. Moving on, foreign stocks, if we look at foreign large caps, down 20.5%. Foreign small caps, also known as emerging markets, down 17.9%. We'll call that one 18. The bond indexes, the core Barclays Aggregate Bond Index, down 10.87%. Now that does not include dividends received. That certainly would have cut that loss from a cash flow standpoint. The yield on a 10-year treasury, so the yield now, is actually up year-to-date 82.56%. If you'll recall, at the end of the year, it was yielding approximately 1.63%, and it ended the quarter at 2.97%. Moving on, broad-based commodities. We use the Goldman Sachs Continuous Commodity Index year-to-date, up 28.2%. And our winner year-to-date is oil, crude oil, year-to-date up 44.4%. Moving on, I also threw in Bitcoin, just for those of you that are following Bitcoin. Year-to-date, it's down 59.96%. We're going to call that 60%. Now that's an overall very, very difficult market. What does it really mean? Well, we certainly have unemployment under control. Corporate profitability has been okay, certainly with some revisions. The large cap tech sector has been hit particularly hard, where staples are holding up on a relative basis better than some of the other primary indexes. We're not seeing much in the way of green shoots. Interest rates are going up and going up rapidly. They're widely expected to continue to go up through the rest of the year. Interestingly enough, 12-month CDs are now yielding just under 3%. That is a massive increase. As we're rolling some portfolios, CD ladders, we're rolling portfolios that a year ago were yielding 0.25%. So what does all of this really mean? Well, it means we're probably not past the worst of it, but we certainly have seen a lot of bad things. Certainly when you're looking at indexes that are down 20 and 30% year to date, it puts them in a rare category. Does that mean we should be going all in and investing all of our cash? Not necessarily, but it means we might want to start chewing on some of these things that are much cheaper around the edges. So all in all, year-to-date, things have not been very good. We have seen certainly some recovery over the last couple of years from COVID, but we're also seeing sort of an overhang of excess liquidity in the system. In addition, on a final note, even though unemployment is low, the employment participation rate, which are the people that are actually out there working as a percentage of the overall population, is still relatively low. We need to figure out a way to give people incentive to go back to work. So this is Brad Harvey with the Q2 update, the year-to-date update. Thank you for tuning in.